While you're still obsessing over whether the Fed will cut rates next week, Wall Street has already torn up the old playbook. While you're staring at candlestick charts, smart money is crunching birth rates, union contract hikes, and the unfolding silver tsunami, and most people haven't even realized what this revolutionary reshuffling of production factors means. If you flip through the latest earnings reports of S&P 500 constituents, you'll find a glaring contradiction. The 10-year Treasury yield is stuck between 4.2% and 4.5%. Historically, such high risk-free rates should signal an economic slowdown and cautious capital. But the reality? Unemployment in the U.S. and Europe is so low it defies belief. This isn't just a short-term cyclical blip, it's a fundamental restructuring of the underlying logic. The old model of balance sheet expansion, relying on cheap labor for scale and zero-rate leverage to sustain inflated valuations, is dead. The market's logic has shifted from growth at all costs to brutal, capital-intensive trench warfare **. Institutional investors no longer care about your total revenue growth. They're focused on revenue per employee, profit margin resilience. If you're still allocating assets using 2010 seconds logic, you're likely to become the last bag holder in this round of valuation reset. To see through this logic shift, we must first dissect the truth behind the so-called labor shortage. Many have been misled by Silicon Valley layoff headlines, thinking the job market is shrinking and AI is replacing humans en masse. But the reality is that white-collar pain masks the absolute dominance of blue-collar and skilled trades. The core contradiction today is a structural skilled trades gap ***. In this cycle, the most valuable assets are no longer middle managers churning out PowerPoint decks in climate-controlled offices. They're the linemen who handle the infrastructure backlog. This is a very specific social phenomenon. In the U.S., a skilled lineman can easily earn over $200,000 annually with overtime, often outpacing junior lawyers and financial analysts. Why? Because the U.S. power grid is over 40 years old on average, extreme weather is increasing, and the talent pool for climbing high-voltage poles is shrinking by 5% annually. When real-world talent becomes scarce, it doesn't just drive up wages, it rewrites the production function. Labor is shifting from a replaceable variable cost to an extremely expensive scarce asset. This shift creates a deadly effect. Corporate free cash flow is being severely eroded. At 4.5% interest rates, capital costs are already high. Add 5 to 8% annual labor cost increases, and profit margins get squeezed from both sides. That's why traditional labor-intensive service sectors, even with growing revenues, are consistently underperforming the market. Many Main Street investors pin their hopes on AI as salvation, believing chatbots and self-driving cars will instantly eliminate labor costs. But as a trading desk veteran, I must warn you, there's a massive time lag trap. Turning AI into real ROI requires enormous capital expenditure. You can't expect a construction firm to start using robots tomorrow, nor can you automate a complex port logistics system overnight. Introducing automation into structurally tight labor markets demands years of heavy capex. This means that before productivity truly explodes, companies will endure a long, painful cash burn phase 10. And in a high-rate environment, Wall Street capital has zero patience. This time lag will cause many AI-wrapped mediocrities to collapse from cash flow collapse before they ever see profits. Then there's the resurgence of union power. From the UAW to the East Coast port unions, their bargaining power has reached 1,970 seconds levels. This isn't just political posturing, it's pure supply and demand. When only 10 skilled heavy machinery operators exist for 50 critical infrastructure nodes, unions don't need prolonged strikes, they just sit at the table and wages rise automatically. This new wage-price equilibrium is actually rebalancing the split between corporate profits and labor compensation. For 40 years, capital took most of the pie. Now the scales are tipping toward labor, forcing a painful downward reset in overall market valuation premiums. Looking back historically, this situation resembles the 1,970 seconds, but more complex and intractable. The 70 seconds saw cost-push inflation triggered by an energy crisis, solved by offshoring factories to Asia, exploiting global labor arbitrage. But that safety valve is now broken. China is aging rapidly, Southeast Asia's infrastructure can't keep up with industrial relocation, and Mexican labor costs have surged 30% in 2 years. The era of global labor arbitrage is over. This means companies must solve efficiency problems domestically at home. And that brings us back to the extremely expensive proposition. Lights out manufacturing. For ordinary investors, this means you can no longer rely on buy and hold the index for cheap returns. The era of beta returns is over. We're now in an alpha hunting phase. You must assume that high labor costs are a long-term systemic challenge, not a temporary inflation blip that rate hikes can erase. So how should we adjust our tactical strategies under this new wage paradigm? First, avoid industries with excessive labor leverage. If a company's profit model relies heavily on low-wage, low-skill mass labor with margins stuck between 5 to 10%, it's a classic value trap. In a long-term environment of labor shortages and rigid wage growth, these firms have no pricing power, only a death spiral of rising costs. Instead, seek out efficiency leaders that can effectively replace labor with capital expenditure. Here's a key metric: revenue per employee. If a company can reduce headcount while maintaining output growth through tech upgrades, it has the DNA to survive post-2025. Think companies deep in surgical robotics or smart warehouse automation. They're not selling flashy software concepts, they're selling the ultimate solution: reducing dependence on humans. Second, focus on sectors with strong pricing power. When wages rise, only companies that can instantly pass costs to consumers maintain free cash flow. Look for opportunities in core medical supplies, precision, high-end manufacturing, and select utilities. These industries share one trait: customers are price insensitive or face prohibitively high switching costs. Let's talk about the return of hard infrastructure. With extreme shortages of skilled tradespeople, especially linemen and advanced welders, any technology or material that simplifies construction processes and reduces on-site labor needs has a massive hidden moat. This is counterintuitive. While Main Street chases virtual AI compute, real alpha may lie in industrial designs that make the physical world less human dependent. The current rate environment is a brutal filter. A 4.5% federal funds rate tells us cheap money is gone. It's separating true cash cows from zombie firms, propped up by cheap capital and cheap labor. In this new era, stock picking has returned to center stage. We're no longer in a broad bull market, we're in a productivity defense reshuffling. The core question you should ask isn't how much will this company grow next year, but if labor costs rise another 20%, can it still generate positive free cash flow? If the answer is uncertain due to labor pressure, no matter how compelling the AI story, you shouldn't hold it. We're in a massive wealth transfer cycle, from pure capital owners to scarce technical labor, from inefficient labor-dependent firms to efficient automated ones. This transition is painful but full of wealth creation opportunities. Don't get distracted by daily headlines. Look at the numbers that truly determine a company's survival. Gross margin trends, revenue per employee growth, and R&D to productivity, conversion rates. In this process, arrogance and inertia are your biggest investment costs. Stay sharp. Watch companies that turn people into capital. Top smart money on Wall Street doesn't care if unemployment is 3.5% or 4%. They care which company first achieves fully automated, lights-out manufacturing, assets that can run 24/7 without union negotiations, or silver tsunami impacts are the new digital gold. In this uncertain era, if you understand that structural labor shortage isn't temporary but a decade-long paradigm shift, you'll grasp why the market is so anxious. Wall Street is repricing the entire world. In this repricing, old idols will fall, and new giants will quietly rise from infrastructure, energy, and automation. For individual investors seeking wealth, mobility, the mindset must shift from chasing high growth to chasing high certainty efficiency. If you see a company investing heavily in automation upgrades, even if short-term profits suffer from depreciation and interest, it's digging the deepest moat for the next decade. Such firms are often dumped by Main Street, focused on short-term earnings, creating the perfect entry point for deep logic investors. We must recognize the era of global arbitrage and cheap labor exploitation is over. The world is now fragmented, expensive, and obsessively focused on productivity. In this context, wealth will inevitably flow to companies solving real-world problems, those making grids smarter to offset lineman shortages, ports more automated to counter-strike risks, and healthcare more efficient to handle aging populations. Finally, in this turning point of the cycle, you don't need a crystal ball to predict ups and downs. You need a logical framework to assess underlying asset quality. While others panic over short-term volatility, you can find truly undervalued efficiency premium stocks by analyzing demographics, infrastructure backlogs, and profit distribution flows. Don't wait for the return of the low-rate, low-inflation era that will never come. The old world is gone. The new era's profits come from pre-positioning in the reshuffling of production factors. Stay calm, keep upgrading your analytical tools, and focus on companies that convert scarcity into free cash flow. This isn't just investment wisdom, it's the only path to survival and victory in the next 5 years. In this productivity defense reshuffling, Wall Street has already repriced the world. Your task is to stand on the side of pricing power. Stay sharp. Watch the pioneers who turn humans into hard assets. They're the true engine of your portfolio's growth. In this wealth redistribution flood, only those with logical insight can stay firmly seated.